Hello. In this video we're going to explain what money is exactly. What's its value? What happens to your money in banks? Is it linked to gold? Welcome, financial enthusiasts, to Smart Finance HQ, where we demystify the complexities of the financial world. Today, we're embarking on a journey into the very essence of our economic system. Money, in its essence, serves three pivotal roles in our economy. Firstly, it's a medium of exchange, facilitating transactions between individuals. Secondly, it acts as a unit of account, providing a standardized measure for pricing goods and services. Finally, it serves as a store of value, preserving wealth over time. Throughout history, we've witnessed the evolution of money from barter systems to coins, paper currency, and now, digital forms like cryptocurrencies. The value of money is fundamentally rooted in trust. When we accept a banknote as payment, we're placing trust in the stability of the issuing government and its ability to maintain the value of the currency. Think of it as a shared belief system. Confidence in the currency's stability encourages its use, making transactions and economic activities possible. It's this trust that gives our pieces of paper or digital entries their value. Central banks play a pivotal role in assigning and maintaining the value of a currency. Through monetary policies, such as interest rate adjustments and quantitative easing, central banks control the money supply. They carefully monitor economic indicators like inflation, employment rates, and GDP to make informed decisions. By striking a delicate balance, central banks aim to ensure price stability and economic growth. The forex market, where currencies are bought and sold, plays a crucial role in determining currency prices. Supply and demand dynamics heavily influence exchange rates. Economic performance, geopolitical events, and interest rate differentials also contribute to the constant fluctuations in currency values. It's a complex interplay that reflects the global economic landscape. In the past, many currencies were directly tied to gold through the gold standard. Countries maintained a fixed exchange rate between their currency and a specific amount of gold. This meant that individuals could, in theory, exchange their paper money for actual gold. The gold standard provided a sense of stability to currencies, as their values were directly tied to a tangible and limited resource. However, as economies grew and faced various challenges, the gold standard became impractical. During times of economic downturns, the fixed supply of gold limited the ability of central banks to implement effective monetary policies. In response, many countries abandoned the gold standard, opting for more flexible monetary systems. Today, most currencies operate on a fiat system, where their value is not directly tied to any physical commodity. While this approach offers greater flexibility, it also requires vigilant economic management to maintain stability. Let's zoom in on the money in your wallet and understand its role in stimulating the economy. When you spend money, you're not just making a personal transaction, you're becoming a vital participant in the economic cycle. Your act of spending contributes to what economists call aggregate demand. Aggregate demand is the total demand for goods and services in an economy at a particular price level and in a given period. When consumers like you increase their spending, businesses experience higher demand for their products. To meet this demand, businesses may hire more workers, increase production, and invest in expansion. This, in turn, leads to economic growth and job creation, creating a positive cycle that benefits the entire community. For instance, imagine you decide to buy a new smartphone. Your purchase not only benefits the manufacturer and the retailer but also the workers involved in production, transportation, and sales. This ripple effect continues as these individuals, now with more income, spend in other areas, fostering economic growth. Now, let's uncover the mysteries behind the money you entrust to banks and the intriguing concept of fractional reserve banking. When you deposit money into a bank, It doesn't sit idly in a vault. Banks operate on what's known as a fractional reserve system. Fractional reserve banking allows banks to lend a portion of the money they receive while keeping a fraction in reserve. This fraction is determined by the reserve requirement set by the central bank. For example, if the reserve requirement is 10%, a bank can lend out 90% of the total deposits it receives. Let's break this down. If you deposit $1,000 into your bank account, the bank is required to keep $100 or 10% in reserve and can lend out $900. This $900 doesn't disappear. It enters circulation when someone else borrows it, perhaps for a mortgage or a business loan. The $900 is then deposited by the borrower back into a bank, from where the bank then continues and lends out $810 and leaving $90 or 10% in reserve. This process expands the money supply in the economy, promoting economic activity. However, it also introduces risks, as banks must ensure they have enough reserves to meet withdrawal demands. During times of economic uncertainty, understanding the intricacies of fractional reserve banking becomes crucial for maintaining financial stability. As we navigate the complex waters of finance, one concern looms large: inflation. Your money loses purchasing power over time due to inflation. Leaving your money in a savings account allows it to basically lose value over the years. To combat this, individuals can strategically invest in assets that outpace inflation, such as stocks, real estate, or inflation-protected securities. This proactive approach ensures your wealth preserves its value in the face of economic changes. That concludes our in-depth exploration of Money Explained. We hope this journey has empowered you with a deeper understanding of the forces shaping our financial world. If you found this video insightful, remember to like, share, and subscribe to Smart Finance HQ. Join us in our mission to unravel the mysteries of finance. Until next time, stay financially savvy.